Before the budget hogs all the limelight and headlines, let's take a look at what the country has achieved so far in terms of the economy. We're sure everyone is excited about today's budget session. After all, the policies that are formulated today will determine the economic future of the country tomorrow. The seed sowed today will grow tomorrow. Before we take a look at the next year's forecast, let's take a quick look at the economic survey. What's that? Read on. Welcome back to Revolution Read On, a daily podcast where we break down one story from the world of business and finance. The Economic Survey of India is the yearly checkup of the nation's financial pulse. It's like a visit to the doctor for the Indian economy. It provides a diagnosis of where the country stands, what ails it, and what could be done to keep the economy fit and running. The theme of this year's economic survey is Amrit Kal. This year's survey has a super optimistic tone. This is India's decade. We are set to become the third largest economy by 2030. Let's see how. Over the last 8 years, we have invested in building our infrastructure for growth. UPI recorded a peak of transactions worth 12 lakh crore rupees in 2022 and is now going international. The banking, non-banking, and corporate sectors have also recovered from the pandemic. They all have healthy balance sheets and are set to grow. Other positives: number one, private consumption is high. Number two, our debt is high but comparatively lower than other countries. Number three, government super high capital expenditure, which has increased by 63.4% in the first 8 months, has helped us grow despite roadblocks like high interest rates. Number four, urban unemployment has declined. Number five, MSMEs are getting more credit from banks. Now that we've set the tone, let's dive deeper. One of the most important insights from the economic survey is the GDP growth for the upcoming year. It is projected that the GDP for FY24 will be 6 to 6.8% in real terms. This is lower than the 8 to 8.5% GDP projection made for the current financial year. Possible reasons for this slowdown are that the global economy might slow down due to central banks raising interest rates to control inflation. However, our chief economic advisor has said that the US is set to narrowly avoid a recession. Super good for us. This global slowdown can be good for us because it will lower commodity prices, which will lower our manufacturing and importing costs. Agriculture. The agricultural sector saw a slight decline in growth from 3.3% in 2020-21 to 3% in 2021-22. However, the government has been working hard to help this space grow. This is being done through several policies: focus on farmer-producer organizations, removal of middlemen, etc. Some key numbers: private investment in agriculture has risen by 9.3%. MSP of all crops set at 1.5x of production costs. Food grain production increased from 310.7 million tons to 315.7 million tons. Institutional credit to agricultural sector also grew. Industrial sector. The industrial sector rose 3.7% in the first half of FY23, which is higher than the average growth of 2.8% achieved in the first half of the years of the last decade. The manufacturing sector is also expanding. Services sector. The services sector is expected to grow at 9.1% in FY23 as compared to 8.4% in FY22. With the right focus and investment, India can soon become a service hub for the world. Subsector-wise growth in the service industry. The IT BPM industry saw a YOY growth of 15.5% during FY22 compared to 2.1% growth in FY21. E-commerce industry is set to grow at 18% as the world is going digital. Digital financial services and tourism and hospitality are also going to witness growth. India's fiscal deficit has fallen from 9.2% of the GDP in FY21 to 6.7% in FY22. It is set to further decline to 6.4% in FY23. Revenue expenditure, however, has grown. This is mainly due to an increase in interest rate payments. These payments rose as the dollar's price rose against the rupee. However, the government's tax revenue has also increased and indirect tax revenue is set to keep rising. The export of goods and services in the first 9 months of the financial year, April to December, is up 16% compared to the same period in 2021-22. One area where we've shown significant improvement is electronics exports. Our electronics exports have risen from $4.4 billion in FY19 to $11.6 billion in FY22. However, imports are still pretty high. With self reliance being a major theme, we can expect the budget to announce more product linked incentive schemes to reduce imports. Last year, we finally brought down inflation to acceptable levels, but this year it is again set to reach 6.8%, above RBI's accepted limit of 6%. So we can expect more interest hikes. But how will this impact our consumption? The survey also talked about various government policies and how they've helped India become the third largest economy in terms of purchasing power parity. The focus on capex has also helped infrastructure development grow by 80%. However, to fulfill our dream of becoming a self reliant economy, we have outlined a few goals. Harness Nari Shakti, focus on the energy sector, boost the MSME sector, focus on education and skilling, and dismantle license, inspection, and compliance to promote ease of business. We guess we'll be seeing a lot of policies focused on these goals in today's budget. What are your predictions? Thank you for listening to this episode. We'll be back with more tomorrow. Until then, read on.